Warren Buffett's stock-picking skills have been widely lauded by financial experts for years. Forbes estimates Buffett's net worth at $124.3 billion as of April 18, 2022, thanks in large part to his constant application of value investing concepts. He has not given in to the temptation of investing in the next great thing, and he has put his vast money to good use by donating to various causes. Given his remarkable track record of finding investments that consistently perform well over the long run, it stands to reason that most traders want to know precisely what Buffett looks for in a company. In this video, we'll explain all you need to know about it. When trying to figure out how Warren Buffett picks successful companies, it's helpful to first examine Berkshire Hathaway's investing philosophy, with which he is most closely connected. When it comes to stock purchases, Berkshire has a well-documented and open policy. Earning stability, strong return on equity, competent management, and reasonable pricing are all prerequisites for investment. Buffett follows the value investing philosophy made famous by Benjamin Graham. Instead of relying on indications like moving averages, volume, or momentum, value investors consider the stock's inherent worth. Understanding a company's financials, particularly formal papers like profit and income statements, is a necessary step in arriving at an estimate of intrinsic value. When making an investment, it's important to choose companies whose prices are much lower than their book values. This suggests the stock is now undervalued by the market and has further to grow. There are several things worth noting about Buffett's value investing strategy. To guide him in his decisions, Buffett uses several key considerations to evaluate the attractiveness of a possible investment. So let's investigate the different elements that make up Buffett's tried and true value investing approach in order to better understand how he came to possess such vast wealth. Safety first. Buffett bases his investing decisions on the principle of maintaining a comfortable buffer. A margin of safety, in the simplest words, is a set of features of an investment that reduce the risk of financial loss. For instance, a $2 margin of safety exists if a stock is trading at $10 per share, but the company's assets are really worth $12 per share. Stock price declines should be limited by the company's fundamental worth. When making an investment, Buffett always tries to pay less than a firm is really worth. According to him, a decade of positive economic achievements might be nullified by paying too much for the shares of a great firm. The performance of the company. Those that have had a positive and acceptable return on equity, also known as ROE, for a long period of time are more desirable than companies that have only had a brief period of strong returns. The more years of excellent ROE there are, the better. An investor should examine at least 5 to 10 years of a company's ROE in order to effectively measure past performance. The company's debt. More of a firm's profits will go into debt service if the debt-to-equity ratio is high. Therefore, that should be a warning signal. This is particularly true if the company is relying on debt expansion for growth. Earnings growth, in Buffett's view, is better served by increasing shareholder equity, or SE. Companies with positive shareholders' equity are self-sustaining, meaning they do not need to take on more debt to meet their financial obligations. Successful stock choosing, according to Buffett, requires a low debt level and high shareholders' equity. How are profit margins? Buffett prioritizes businesses with high profit margins, especially those whose margins are expanding. Similar to how he accounts for short-term fluctuations in ROE by looking at the profit margin across many years. For a firm to remain on Buffett's radar, its management must be skilled at increasing profit margins year over year. This indicates that operational expenses are being kept in check. How distinctive are the business's offerings? In Buffett's view, a company that makes a commodity good is riskier than one that makes a specialty item. Oil, the product of an oil firm, is not particularly distinctive since customers may get oil from a large number of different rivals. But if the corporation has access to a higher quality of oil, one that can be processed more readily, then that may be a worthwhile investment. The company's ability to produce a higher quality oil might give it a leg up on the competition, leading to more sales and higher margins. The question is, how deep of a discount are stocks now trading at? The essence of value investing is finding strong businesses that are trading at a discount to their intrinsic worth. Value investors, like Buffett, look for businesses that are trading at a discount to their true worth. When a company's present market value is less than its true worth, a buying opportunity occurs. There's no universally accepted method for determining intrinsic value. Rather, investors use a wide range of information, including corporate governance and earnings prospects, to make educated guesses. How does Warren Buffett approach the market? One of Warren Buffett's numerous investing tenets is the need to make an investment in one's own education. He has emphasized the importance of education in being a successful investor. He also thinks it's important to invest in oneself financially by not living above one's means, staying away from credit card debt, putting money away, and reinvesting one's earnings. Buffett is well known as a value investor, but he's also a buy and holder. In selecting companies, he's looking for those he feels have high long-term growth possibilities rather than short-term profits from selling. So this causes him to stop paying attention to what other people are doing. Instead, he considers if the firm has a good chance of making money in the future and whether the stock is reasonably valued. Buffett has continued to adhere to his investing philosophy up to the present day, as evidenced by Berkshire Hathaway's current ownership of stock in Apple, American Express, Bank of America, and Coca-Cola. There's no special trick to investing like Warren Buffett. The Oracle of Omaha's investing approach is so straightforward that it often surprises novice investors. In a nutshell, Buffett seeks out exceptional companies that are selling at discounts to their true worth and then hangs onto those shares for as long as possible. So that is all we have time for today. Thank you for watching, and please remember to like, subscribe, and hit that bell icon to receive notifications for our latest releases.